I have NQSOs from Netflix. I have, let's say, at the money for Spotify and options. And then I have at Airbnb, I had pre-IPO shares that were ISOs. The point is that it can be very complex. It can get very cumbersome because you're not dealing with potentially just one company. You could be dealing with multiple. And then how does that intertwine with not just your own little portfolio you've created, but your financial life? And then how does that also then intertwine with your taxation? And how do you make sure that you maximize that as well? In addition, trying to make sure that you maintain the value. And one of the things here that always rolls back to is if you can have a long-term mindset on the shares that you own, it makes this a lot easier instead of having to use it in the short term. Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. Here with your hosts, myself, Tim Bickmore, and my colleague, Dan Weiss. Nathaniel Leach is out today. He will not be with us. Today, Dan and I are going to talk about stock options. We see it a lot. We've had a lot of different experiences with it. It's very interesting, a lot to cover, but we just want to shed some light on the education behind what you should look for, what you should look at, what kind of questions you should honestly just ask. Before I kick this over to Dan, because he's going to be leading this ship today, I just want to tell our listeners and our viewers, if you like what we do, one big help for us would just to go and like, share, subscribe to our podcast. We are all over the place: Apple Podcasts, YouTube, Buzzsprout, Spotify, you name it, we're on it. So with that being said, Dan, let's talk about stock options.
Gotten really good at that shameless plug, Tim. That was great.
Shameless plug is my game, you know. Gotta pick it up.
More shameless plugs. We spent a lot of time talking about options, RSUs. We'll talk about some of those differences, like Tim mentioned, with a lot of our clients. We see more and more of that. It's a very common way to provide employees equity, and something that has to be considered when you're looking at an entire compensation package. There's a lot of entities, as a lot of our audience knows, working within particularly the tech sector. Quite often we see this, and with startups we see this quite a bit too, where your package is not just cash. It can be cash through salary, through bonuses, and through a lot of other equity packages that can indeed sometimes be equivalent to another package, but it's just cut up very differently. This is a very confusing topic, right? So we spend a lot of time educating and reviewing some things that people think they know, or most people just realize, I don't understand this, but I have no choice but to play in this game. So I'm going to ask Tim, who deals with the majority of this inside the firm, a number of different questions that we'll go back and forth on some things that we often see, often create questions or should create questions, and how you should perhaps think about these particular items. So there's a lot of different kinds of equity in this fashion. We could be talking about RSUs, restricted stock units. We see that a lot, especially in entities that have begun to mature a bit. We see a lot of non-qualified stock options, right? And we see a lot of ISOs, which sometimes can be time-based, sometimes they're performance-based, but just to name a few. So why don't we start just talking a little bit about how these differ a little bit, and then we can kind of also then walk our way right into how an option works.
Sure. Before we jump into those three different opportunities to participate within the equity of the company, I will say as well that a lot of this conversation will come down to some of our clients that are looking just to participate in maybe angel investing or VC investing, where a friend, sends them hey, I'm raising money for a company. It's really participating within an equity package. You're doing the same thing when you're actually going to work for a company. Even though you may not be investing your actual dollars, you kind of are, because what they're doing is they're leveraging their equity compensation package to be able to lure you in to be able to participate within the growth. So you really do become an investor within this firm, similar to that. So this has a lot of carryover, this conversation may have a lot of similarities when it comes to just straight up wanting to be an investor, and then also being an employee going into a company that's going to offer an equity comp package. So I just wanted to throw that in there before I started into some of the definitions. But I think for today's purposes, because literally we could have a conversation about this for a long time, but our viewers don't want to listen to us that much. So we'll just boil it down to, like Dan said, to the three. RSUs, as Dan mentioned, restricted stock units. NQSO, non-qualified stock option, or ISO, incentive stock option. So just kind of cut this up really quick. Let's break out RSUs, restricted stock units, compared to these options on the other hand, or the NQSOs or the ISOs. RSUs are not an option. So you do not have the right to buy the stock of the company at some determined price. What RSUs are is what you really want to focus on is the restricted stock unit, which essentially means that you're being restricted from owning these units until something happens, right? That's why they're restricted. This is very important when it comes to the IRS rules as well, because when these RSUs are granted to you, they're not taxed. Why are they not taxed? Because they're restricted. They're not technically yours yet. They're not in your receipt. So that means that the IRS will not tax you on these options when they're granted to you. However, when these RSUs do become yours, or what's in their industry, or what the terminology is, once they're vested and they are officially yours and they're no longer restricted, what happens is that depending on the share count you have, and then the percentage of vesting at that time, whatever the stock price is at that date of vesting, you're going to receive that amount of money or that amount of shares. And then that will actually be taxed. Now, what's interesting about RSUs specifically is that when they are taxed, they're considered W-2 income. So it's almost like you just got paid in salary, but instead of getting paid cash, you got paid in stock. So the company's probably going to withhold some taxes on your behalf, and you're going to get the net amount. And then you own the common stock. You can trade it as you see fit. If it's a publicly traded company, it's probably more easy to trade. If you're still private and you vested, it may be still pretty illiquid and not have the ability to be able to be traded. So the reason why I bring up RSUs compared to ISOs is that the functionality and how these work is very different. If we flip over and look at just the ISOs and the NQSOs, what you're really receiving is the right to buy the company's stock at a determined price, or your grant price, or what could be considered your strike price. And you have the ability to buy it at that price, whatever it may be. Now, NQSOs and ISOs are different, right? Non-qualified is the word I want to pick out there, and incentive is the word I want to pick out on the ISO. Non-qualified, what that means is there's no benefit from a tax perspective. The IRS is just going to treat it as if you bought it and owned it on the common stock market. There's just no incentive. It's not in an IRA account. There's no qualification for an advantage to taxes. The ISO, what we have to pick out there is you want to think of incentive. What incentive do I get? Well, the IRS is going to give you an incentive to be able to get less taxation because they're going to tax it differently based off of a certain criteria. So with ISOs, when you're granted, similar to RSUs, you have to be granted, and then you have the ability to exercise. So you can have the ability to buy. Once you exercise that stock, what will happen is if you hold the stock after you buy it for over a year, and in addition, it's been 2 years since it was granted to you, that gain that you make, instead of being income taxable, it becomes long-term capital gain tax. So where's the advantage here? Well, if you think about it, if you started at Snapchat as maybe employee number 6, and you got 100 grand worth of ISOs, and you sat on it and you exercised and you waited till it IPO'd, if you compare that to getting a non-qualified stock option, the amount of taxation that you can save is massive, right? Because that's a high performing, or not high performing, but a high growth price stock that you probably could have saved so much taxes based off having that incentive of being taxed at different rates, even compared to RSUs, which again run through income. Now, RSUs, there's different ways you can go about trying to mitigate your taxes, which I don't know if we want to get into that today. But those are really the difference. And then the difference between these two, right? So the tax is going back that you have the right to purchase this stock, right? And you typically have a certain expiration date on these options. So I use the example right now as GameStop. People know it because they heard about it, they read about it. And what was everybody doing? They were buying call options. They're buying, and what a call option is you're betting that the price is going to go higher from here. And it's kind of a leveraged bet. Non-qualified stock options and ISOs work very similar to a call option. They're kind of like a glorified call option. So the benefit to them is that if you do have hyper growth within a company, it can be very advantageous to have that type of equity package. However, if you don't have that kind of growth, it could actually be disadvantageous compared to RSUs. And you have the right to purchase it at a certain price. And then you can own it. So when you exercise, it doesn't mean you're selling out of it. It just means that you now have receipt, you have now ownership of the common stock that you just exercised. And we can get into what a cashless exercise is, what a cashless exercise, cash exercise, how that can function. If it depends on if you're publicly traded, not publicly traded, the liquidity. So those are kind of the breakdown, which again, that's a lot of information just right there. But to simplify those out, right? RSUs, you will own the units. There is no right to buy the stock. It'll be yours once you vest. ISOs, NQSOs will also have vesting periods, but what you do is once you're vested, you then have the right to purchase the stock at a determined price.
Yep. So ISOs, non-qualified stock options, you don't own the stock, you own the right to buy the stock. That's the option. And with an RSU, you own the stock, it's just restricted, which a lot of times you'll hear terms like cliff, right? When it comes to your RSUs, right? It's a common term. I was like, what the heck is a cliff? Well, this goes to the vesting period and you get a large chunk of it. Maybe because a lot of times we see time vested RSUs, probably more than anything else, right? Mm-hmm. And so maybe that means after the first, whatever be the case, year, 25% of your stock units are no longer restricted and you can sell. Now, this is a really important point because when we're helping clients decipher and verify packages, which I think this is probably a good transition to talk about that. It's very complicated, but there's a lot of things to consider here. Understanding the kind of equity you're at play here is really important because it determines the strategy here. If we're helping someone move from, let's say they're moving from Netflix, where we have a lot of our client base, where they're paid a lot of salary, right? But the options at Netflix are non-qualified stock options. They're very straightforward, actually, right? It's confusing and when you don't know the realm of it, but compared to other things, it's fairly clean cut, right? And let's say they're going to go take a job at Amazon, right? Which Amazon offers RSUs, right? And the RSUs there are actually pretty simple, right? We're not talking like Spotify where we have people where there's a lot of different options, which is really cool if you know what you're doing, right? So the difference there is that Amazon's probably going to pay you less, but you're going to get these RSUs, right? So understanding how you're going to utilize this, we have a lot of people that when they take a package like that, they have to consider, I may need to sell some of these RSUs when they vest to supplement my salary so that I don't have to change the way that I live because I'm leaving a higher salary job, right? So just to give you an example, but I'm going to turn it over to Tim, who again leads the verification process. Tim, can you talk about a little bit more about strategy, what we're looking for inside of a package, where different share classes can make a huge difference, and what those strategies can look like, right? We talked about taxation. That's a big deal depending on where you feel you sit inside that company now and then tomorrow.
Yeah. So when we have people look at comp packages, I think to kind of frame this for our listeners and viewers and simplify it is I think step one is this a publicly traded company or is this a private company? So if we can answer that question first, right, from a decision tree, if it's publicly traded, it's a little bit easier to start analyzing the package. And the biggest reason is liquidity risk, right? It's usually very liquid. It's exchanged on the typically the market, which means that you can buy and sell it. So once you're vested, it's probably pretty easy. Dan just mentioned two big companies, Netflix and Amazon. If you're in those and you're vested, you own those shares, it's pretty easy to buy and sell Netflix on the exchange. Not a big deal. And so that is really kind of point one. What happens though is we get companies that are, let's say, pre-IPO or startups, and they're doing very well. What you have to understand there is when you're looking at it from a verification or you're trying to understand your package is when do you think they're going to potentially exit or go public? Doesn't mean they have to go IPO. They could go public in a litany of different ways, but you got to understand, okay, what is the trajectory of that? Because just because you're vested within the stock doesn't mean you can actually get the cash. So as Dan mentioned, let's say you get pulled from a publicly traded company and you go to this new hot startup and you're like, this is going to be a great transition. We verify that you can afford it from an expense standpoint, which we do during our planning process. Yes, not many advisors do, but they should. And then we look at what the impact's going to be on cash flow, how that's going to impact goals, and then say, hey, what do we really need to do? Do we need to live off of this money? Well, let's say that we do. The issue there is, let's say that, this new startup has, as Dan mentioned, a 25-year cliff and monthly vesting thereafter. So what does that mean? 25% of your shares are vested at the first date of your first year and your first anniversary date. Okay. And then from thereafter, you're going to get a percentage of vesting for the next 3 years. So it's a 4-year total vesting, and that's what you're going to get. Awesome. We look at it, we're like, you know what? That signing bonus, we probably can actually last for this year. But then when those 25% come due, then maybe we look at selling. Well, if it's a private company, it's not that easy, because the problem is there's no marketplace to go ahead and sell these shares. It can be very difficult, actually. And typically speaking, what happens is when you can sell it is either the company's going to tender offer your shares, meaning they're going to come back to you and offer to buy them back, or there could be an internal raise where other investors will come and buy your shares. The issue, if you're at a hot startup, right, or even let's say it's not even a startup, it's a mature startup, right, looking to go public or looking to exit in some capacity. But let's say that you're there. The offer you're probably going to get may be significantly less than what it would probably go for on the exchange, theoretically, right? So that's something you have to weigh as well. But in addition, you don't know if they're going to raise that. You don't know if they're going to create a liquidity event for you specifically. Now, founders will sometimes create liquidity events for themselves because they want to be able to monetize what they've built over maybe the last 5 to 10 years. But that doesn't necessarily mean all employees will get that opportunity as well. So just from the get-go, it's, are we public or are we private? Strictly for the liquidity piece. From there, that's when we start looking at what type of options you have, right? And the reason why this is important is because let's say that we get ISOs, which a lot of early startups give out for the obvious reasons I just mentioned, big tax incentive. The issue there is the exercising of said options. And why is this important? Because within private companies, because there isn't liquidity within the market, it can be very hard to do what's called a cashless exercise. A cashless exercise is where you don't have to bring actual money to the table and can use your built-in gain essentially to like leverage it to be able to purchase the stock at the purchase price and then capture the gain. It's actually a really useful task to do. And there's some like the intricacies on how that goes about it is there's some margin that's used and custodians do that, but it's a nice way to go about being able to exercise without having to bring your own hard cash from your bank account to buy these shares. So for example, you're at this kick A startup. All of a sudden the price has jumped. You want to exercise. So if the stock price is at $10 per share, that's what you can buy it at. That's your strike price. And let's say that you have 10,000 shares. You would have approximately $100,000 worth of shares at that strike price, which means if you're going to do a cash exercise, because it's a private company, you need to bring $100,000 to the table in order to exercise that stock option. It can be very difficult for a lot of people. Not a lot of people just have 100 grand sitting around. They're like, yeah, you know what? It's time to exercise this. Let's go ahead and do it. So there are companies out there that will actually facilitate this. I would warn you, make sure you do due diligence. Just do it. You just really need to look into it. See what they're going to take. I mean, there's no such thing as a free lunch, right? So overall, though, it's something that you have to take into consideration. However, when we're looking at it, we also have to think about it from the standpoint of the tax incentive. It may be very advantageous to have these ISOs. However, what you really need to look at is what is your long-term play on this specific option? This can't be where you have to live off of it. Going back to the first question Dan asked is if we have to use this to live based off where our lifestyle's at, it may be very difficult to do. So those are just a few of the basics of what we're looking for verification. And I know, Dan, that we can get into a little bit more of specific, like if you really are in an early startup, are you in a common stock? Are you in preferred stock? What does that look like? What are the terms of those options or those options, meaning the terms of the equity that you're participating in? Which round are you in? Right? That all becomes something that's very important to understand because that will dictate value and that will dictate potential dilution, which we can get into. On the public side of things, if it's a publicly traded company, that's why I said it's just a lot easier. You can do a cashless exercise, right? Because you can go ahead and you leverage the custodian, use your gain, purchase the stock, move on. So the liquidity piece we can access. So if someone came to us and they're like, hey, I want to go to Amazon. Amazon's offering me non-qualified stock options. Awesome. I need to live off them, Tim. Okay. First, are you comfortable with the potential volatility of that? A. And then B, great. Once these things are vested to you, what we're going to do is we're going to turn around and exercise them and we're going to sell them. Right. And we're going to also look at the taxation of that, but that's what we're going to go ahead and do because you need this money to continue to sustain your lifestyle. Is that something that you're comfortable with? Here's to the impact of your goals. Here's the impact of what's going to happen. And by the way, yes, we do this. And how's that going to work? And then the client can make an educated decision on if they should do this or not. But it just makes that decision tree simplified. You go private, it just complicates things due to the illiquidity risk.
Two things I want to touch on what Tim just said there and go a little bit further on, and then we'll wrap up because we don't want to cause any migraines for people. Hopefully the information is very valuable, but we know it's a lot. We know it's heavy stuff. So one thing I really want to stress when Tim's talking about the different series and so on that you can be involved in here, that you really make sure that you keep a close eye on that, because unfortunately we have seen with a couple different entities that sometimes the date that you were granted these options changes. And if it changes and puts you in a different round, for example, then that means that your gain can be significantly different. And a lot of times we feel that this goes unnoticed by employees until that happens. And then it's like, well, it was there. It's just you didn't realize the impact at play. Same with common or preferred, right? Make sure you understand what you own because that can really change the picture. Other thing, right, is when exercising these options, often we see a 10-year period to exercise. That's very common, right? But those periods can differ. And a lot of times people don't do anything about it. Either they do too much where they're constantly just trading to trade, or they don't do anything. We very rarely actually see in the middle. And so you have to understand how that's going to work for you. There's a lot of different reasons as to why you should exercise your option. And again, this does not mean you have to sell the position, right? Just to clarify, there's a lot of confusion around there. But exercising the option, right, can be very different. So for example, we like to create decision trees for our clients so that we can walk through different options to, I guess, exercise options, right? You might be selling because you need the money for something that makes sense to use the money for. Exercising and then selling, right? You might be exercising because you're trying to mitigate the tax impact over a span of a number of years. This is a big mistake we see all the time, is where people don't do this and then they all do it in the final year or two. And the problem with that is you've had a buildup of what could be 10 years of these options. And when you exercise those, it's going to affect your income, right? And therefore it's going to affect your taxation. Whereas if you would have spread it out, you would have paid less, right? So understanding what that looks like as well. Obviously, the comfortability with the entity that you own should be considered. How concentrated are you in that position, and are you comfortable with that? Should be considered. There's a lot of different things to think about. It's not just simply, oh, I think the value is going to go up, which, by the way, options are very much tied to actually more so the volatility of what's going to happen with that entity, not maybe so much the value in comparison, right? Which we won't get into that. That's a whole other conversation, but that's how that relationship really works. Tim, do you have anything else to add before if you want to kick off the close
Yeah, well, I'm just going to actually add on to a couple of things that you mentioned, Dan, which were really good. And one of them too is that I forgot to mention is talking about kind of the illiquidity is depending on where you sit within the company, and even sometimes it's just general employees as well, as there are blackout periods with publicly traded companies on when you can and cannot sell, or even exercise potentially your options. A good one is like some publicly traded companies you can exercise in the blackout period, but it has to be a cash exercise, not a cashless. So that's also something to pay attention to. So I'm going to back my statement off just a little bit on the liquidity. It is significantly easier, but there are some hindrances such as that you just have to pay attention to. The other thing too, Dan, that you were mentioning, which was really good, is there's just so many different ways of looking at this concentration risk. There is looking at, how it affects your overall portfolio. But the one thing that I also kind of like, and it's very interesting, is that if, let's say, the listener or viewer is part of a tech company, the tenure at these companies, Netflix, Amazon, Facebook, Spotify, Hulu, whatever it may be, is roughly, I think, on average, about 2.5 years. So, or Facebook and Google too, or Google's another one in there. So the reason why I bring this up, our generation is starting to shift jobs a lot more frequent. And what people are doing is they're gathering up these options and these shares. They're vested and they get to leave with them, right? So you're kind of creating your own portfolio of potential pre-IPO shares, potential publicly traded shares of companies that you can utilize, which is very interesting. But the only way to really look at it as a portfolio is if you don't have to use it. So if we could help somebody plan to just be able to live off of their salary, they can actually start accumulating a bucket of shares that other people may not have access to in a very advantageous way. A lot of publicly traded companies will also throw you ESPPs, employer stock purchase plans. Not the time to get into that, but that's another way to access shares. However, you really need to be in a position that it makes sense to do that so it doesn't disrupt your goals. So when it comes to strategy, and then the tax strategy too, with all of these, if you have NQSOs, ISOs, there's a lot of taxation issues we would have to go through, AMT tax, all that other fun stuff that we won't dive into. But the reason why I bring that up is you can start being advantageous by your exercising depending on what you hold. The reason I say this, I have Airbnb shares, I have Spotify shares, I have Netflix shares, I have NQSOs from Netflix, I have, let's say, at the money for Spotify and options. And then I have at Airbnb, I had pre-IPO shares that were ISOs. You could start looking at how to exercise these to actually make it advantageous to lower your taxation. I know that sounds crazy, but sometimes the more income you make, you actually may save some taxes from an ISO perspective. So the point is that it can be very complex. It can get very cumbersome because you're not dealing with potentially just one company. You could be dealing with multiple. And then how does that intertwine with not just your own little portfolio you've created, but your financial life? And then how does that also then intertwine with your taxation? And how do you make sure that you maximize that as well? In addition, trying to make sure that you maintain the value. And one of the things here that always rolls back to is if you can have a long-term mindset on the shares that you own, it makes this a lot easier instead of having to use it in the short term because you reduce the potential volatility risk. So that was what I wanted to add to you when you were walking through that, Dan. I was thinking about all that fun stuff. So
those are great points. I think, Tim, we're yet to see an Amazon client actually obtain all of their RSUs be due to vesting is due to that time frame. I mean, if you've got Amazon on your resume, you also have some grit to you. It's a tough culture, and a lot of people don't stay for longer than that period Tim mentioned.
And if you do too, what happens is what I always like to remind people is that let's say that you go to this company, you take a lower salary, it's a startup, but you're a high performing employee. What also has to be taken into consideration is they don't usually stop giving you options. They don't stop increasing your salary, right? That if you're a high performing employee in the company and the company's doing well, they're going to do their best to retain you. So they potentially are going to compensate you more. So that's the other part too, is when we're talking about concentration, is it's not even just looking at the snapshot today, but trying to anticipate the future. And a lot of that has come to fruition when it comes to some of our clients where we're like, we know you're good at what you do. They're probably going to throw some more on you. And then how is that going to work? And then how do we balance that? So it's an ongoing continuous thing. And it's becoming such, not to like take a too big step back, but if you go back to 2000 to 2001 and you look at what happened in the tech bubble, is that's when equity comp packages were at their height. And a lot of people lost a lot of money in stock equity plans due to the tech crash back in that time frame. And you really didn't see stock compensation packages getting as hot as it is now. But in the last decade, probably since 2008 and above, equity comp packages are becoming more of a hot topic for employees. And it's not even just executives anymore. It's just, it's general employees who are coming into the firm. And it's become, people have done very well. Again, going back to Pinterest, Spotify, Netflix. I mean, these companies have performed exponentially from a price perspective. And so these equity comp packages have creeped back in where advisors were typically only advising to these high level executives, but people who are now general employees are dealing with these exact potential issues and problems, and they're getting missed because it's not where it was before. It's advanced now. And so, but it's extremely important because, I mean, Dan, I honestly don't know that any of our employees who work with at least newer tech firms, and even some tech firm, like old firms, Disney, for example, who have transformed into a tech firm, are now also giving a lot more equity comp packages because you have to compete in the marketplace. How are you going to compete with Netflix and Amazon and Facebook? Or even you have to.
Yeah, because you don't have the cash.
Yeah. And so it's not just now these high level employees that are getting all the stock compensation packages. It's the general employees as well. This is a topic that needs to be discussed more often, and it needs to be educated to the general employee, because, you know, they get lost at what's an RSU. And now you're asking me to pick between a non-qualified stock option or an RSU, or the at the money stock, or over the, you know, or over the out of the money. What? Am I playing with GameStop stock right now? Like, I don't understand what's going on. Like, you know, so it's complicated.
What you just said reminded me of two other things that I just want to throw out there for people to hear as well. One of which is, because we see this all the time when we're comparing, again, people's compensation packages and helping them figure out if it makes sense to leave one job for another, is Tim made a great point. A lot of these less mature or startup ventures, they may not have the cash to offer you. So they're going to offer you these different forms of equity because it's their own currency. So they'll look at it that way. They can do it. And now the way for you to think about this too is that if you are at a point where you can't drive more cash, it's a lot easier to ask for more equity then, because again, it's their own currency. Just something to consider. The other thing that jogged my memory when he was talking too was another reason to consider perhaps exercising options is a major life change. So like Tim said, you might be leaving one job where you have a major salary to go do something else, something challenging, something more creative, and enter into the startup world where maybe you're getting these options in lieu of a lot of salary. This might be a situation where it may make sense to exercise old options that you have because your income is lower. Or maybe there's a marriage occurring, and maybe that means that your partner doesn't bring in the same kind of money you do. And therefore, your household income is going to actually be less, relative speaking. Maybe a good time to exercise. Or the reverse. Maybe you're marrying and your partner makes significantly more than you. Well, you may want to do this now before this actually happens. Just to give some other thoughts. Tim, did you have any other final thoughts as we wrap up?
Oh man, final thoughts on this one. I mean, I could talk about this for days. I get all excited about it, and I think it's a fascinating subject, and it's amazing to see all the packages that we've seen. It's really nice to kind of look at and see what is being offered across really the bigger, the bigger tech firms and how they're structuring their deals. And I think my final thought is like, I just don't know. How do I say this without being rude? I just don't know that companies are really taking the time to explain. And I know it's not their responsibility either, right? And there's a lot of liability to it. And all the documents that any employee is going to get, it's going to state, go talk to an advisor, go talk to a tax professional. But some of these decisions are really a big deal. and there really can be complicated, and you got to understand what you're getting yourself into and how it truly impacts you. I hear too often from our clients that it's like, oh, I just accepted it and that's really cool. And they also give me 200 grand salary, right? Like, but if you can be strategic and you can understand it, or at least be educated to a point, or have somebody in your corner that can understand it and educate you on it, it can become a leverage point. And it can be to the point where maybe, as we're talking, right, is if you're younger and you're getting your start here, what I love to tell people is that you're now positioned differently. Okay. So people who have worked for Netflix, it's like going to Harvard. People who go to Harvard, regardless of what you think about Harvard, have Harvard behind their name. That puts them at a level that's going to be very different than maybe somebody that went to a junior community college. It just is. So when you go to these top firms like a Microsoft, a Netflix, and you have that title behind your name, it provides leverage for you to then go and get another job at a similar type of a company, which, guess what? You're going to get more equity comp packages. So if you can start figuring that out and say, oh man, if I move around and I'm moving up the scale to get where I'm going to be, and I'm strategic about the salary, but also strategic about this equity comp package I can get, that's where you literally can start taking advantage, where you're like, great, you want to give me more money because I'm doing a kick-ass job? Give me some more equity, because I'm already set. I'm already positioned to be able to live off of what I have. And that's how you start have the ability to take that, leverage it, and build compounding wealth. But if you have to continue to use your equity comp package to get yourself out of credit card debt, to do different things, it can be difficult to build up that type of a portfolio on your own. So that's my final thought. And then going back to the education, is that don't assume your company is going to educate you on this, because it's really not their responsibility, and they're just not going to do it. And they'll do their best. They provide a lot of documentation, but that means you got to read through it. You got to understand it. You got to ask questions, and that can take a lot of time. And if you're a client of ours who is in one of these companies, you're already working 12 hours a week, so you're not going to have time to even think through it anyways. But it really is important to understand, because it can definitely benefit if you do it the right way and think about it strategically, both today and for the future. So that's my final thought on the equity comp packages.
And I mean, that's a great point about going to your company, because a lot of times the companies don't even know. You have to keep in mind that those companies are not here to provide options for you. They're here to create phones and streaming services and other things, not create options. So a lot of times there's a misconception there that your company will understand this and know, and most time we find that just not the case. I have one clarification, two comments. Clarification two, we talked a little bit about going to a third party for a cashless exercise, which we see a lot too. Keep in mind that's not always the case. So with a larger entity, sometimes you do find that entity can facilitate that cashless exercise. And so that can be an option, but also do not count on it, right? Do not count on it. Two comments. Comment number one. So if this resonates with any of you, if you're like, oh yeah, that's me, I'm getting these things, or I'm going to, and so on too, I'm going to go from Microsoft to, wherever be the case, but another like-minded entity, for example, your life's not going to get less complicated with these items, right? This is not a one and done situation. This is I received this, and now you have to strategize over this for usually years on end. And then if you go somewhere else and you're building this mix, it can be a really cool value, like Tim was speaking about, to build this into play, but it doesn't get less complicated. So keep that in mind, because I think sometimes people will oversimplify this so that they don't have to think as much as they perhaps need to on this. And that's a dangerous thing. Speaking of which, second comment, if your friend or colleague comes to you and says, oh, I did this, I took the ISOs, I whatever be the case, I decided to exercise this because of X, Y, and Z. The correct response to that, and the only response to that, is thank you. I'll take that under consideration. And because the reality is your scenario is not their scenario. And again, this is not as simple as, oh, ISOs are better, RSUs are better. That's not the case. Totally depends on your scenario and what you're trying to do, how comfortable you are with the situation, how comfortable you are with the entity you're working for. So thank them. And hey, I appreciate that. And then think about it. Consult others that know, talk it through, but it's not that easy of a decision. So with that being said, we, as always, appreciate your attention and tuning in, and we look forward to talking to you again here soon. Take care.
Thank you. Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,